Hey, this is Geoff Gannon, and you're listening to the Focused Compounding Podcast. This is the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focusedcompoundinggazette.com. That's focusedcompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focusedcompounding.com or text or call Andrew at 469-207-5844. And now here's Andrew with your regularly scheduled podcast.
Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding. Thank you so much for tuning in. Mr. Geoffrey Gannon, how's it going today?
It's going very well, Andrew. How's it going with you?
It is going great. We are sitting in our new... Should we call this a studio? I guess you could call it a studio. You know, it's a little bit of a work in progress, but we're sitting here in our office in a new spot. Obviously, in my old office where you could see the street view, it was kind of messing with the lighting a little bit and like the quality of the video. So we're happy to be in here today. Hey, if you're not following me on Twitter, you definitely should be following me at Focused Compound and check out all the work that we've been pumping out on YouTube. We are pretty much uploading a video a day. Yeah. Somebody said to me the other day, they're like, man, you've been pumping out a ton of content. And I was like, that's the greatest compliment that anybody can give me. And we're doing 3 videos a week on everything investing related. So it's been a lot of fun. So make sure you hit that subscribe button there. And then, of course, if you like the work we're doing here, definitely be sure to support by leaving a rating and review. That goes a long way. So one of the most popular videos that we did recently was the video about how to read a cash flow statement. And I think there's a lot of people that are interested in this just because accounting for some individuals can just be maybe it's a simple concept, but actually relaying it to how to invest and like how to interpret certain accounting things for investing, I think is kind of complicated maybe.
Okay.
So I think it's good to continue on with this series. And today we're going to be going over the balance sheet. So obviously balance sheet, you started off really as more of like a Grahamite, I guess you could say. And obviously he focused a lot on the balance sheet.
Yep.
So, maybe just kind of give us a snapshot of the first things you look for that stand out to you when looking at a balance sheet. And we are going to be using Apple's Q3 balance sheet if anybody wants to follow along. So go for it.
Yeah, so the first thing that I notice is if there's a lot of cash. The second thing is usually comparing current assets to total liabilities.
Got it.
So an important thing about how much, if they have extra cash, would be that you could basically take their current assets, subtract their total liabilities, and if that number is greater than their cash, then their cash is probably all surplus.
Yeah, it's a sign of a very solvent business, as you could say. Yeah.
And so that's a very quick way of calculating it. It's also just a very safe business generally if you're going to see current assets exceeding total liabilities by a lot. I don't pay a lot of attention to the property, plant, and equipment so any of the fixed assets, the non-current assets, as being something that's going to help you in terms of the safety of the business and things like that. So you're going to get that either from current assets or from cash flows and things like that. Obviously, a company that has losses or something might be still in a risky position even if current assets exceed total liabilities. But as long as it's making money every year, has positive cash flow, then you're probably not going to have that problem.
Got it. Okay, so you like to take the total current assets and that it covers the total liabilities of the business.
Yeah,
and
like
obviously,
compare them,
and that obviously shows that if the current assets, what a current asset is, what could be converted to cash relatively quickly, if that could cover all of the liabilities of the business, that's a very good sign of a very, I guess, well-capitalized business, right?
Yeah, so it's going to tell you right away, and that there might be excess cash.
Yeah.
So if you look, and even if the company has a lot of cash, some companies will say, some investors will say that a company has net cash if it has more cash than debt.
Yeah.
But the truth is, that might not be as, you might not be as sure that it does have a lot of net cash unless you see it covering current assets. Without the cash, current assets would still exceed total liabilities. If current assets still exceed total liabilities without the cash, that's definitely excess cash.
Got it. Okay, so then what do you like to see, I guess, more so? So moving down to long-term assets, you spoke a little bit about PP&E, how you don't really worry too much about it.
Right.
And now I'm guessing you meant that as because the solvency, right?
It's not a positive. So I do look at it in terms of how it's going to hurt your return on capital, things like that. Yeah.
Got it. So, what do you mean by that?
You don't want to see that be a big number. If it's a big number, it's a problem.
And that's because we wear asset-light businesses that produce a ton of cash flow.
Because you know that you're going to have to replace that property, plant, and equipment. So you're going to have to do CapEx in future years to replace that. Yeah.
Got it. So when you're looking at businesses' receivables, for example, what are you looking for in that line item?
Just how big it is generally. So how big it is versus the rest of the balance sheet total, just eyeballing it. You also, if you've seen what sales are from the income statement, that's also important. But generally just seeing in what the relationship is between receivables and inventory, receivables and the liabilities that you see there, how big an item it is. Receivables are, so, I mean, if the business isn't performing well, receivables are a form of safety, right? Because if the business had to be liquidated or something, that would be, or just to shrink, that would be something that's going to turn into cash and going to turn into cash at a very high rate. It's almost as good as cash. But in terms of an ongoing business, receivables are not a positive. They tie up money that would otherwise be in cash. And so you don't want to see that be a big number in terms of your looking for returns in the stock. But if you're looking at it as a net, or you're just seeing if there's a lot of safety and stuff, then absolutely, yeah, a lot of receivables mean that it's safer. Yeah.
Sure. So I guess we could talk a little about that for a little bit. So nets. What are you looking for on the balance sheet when you are looking for a net?
The best is to have it all be cash. Okay. And the second best would be cash and receivables. Much, much worse is cash, receivables, and inventory.
Okay.
I think Graham broke it down as sort of like 100 cash is worth like 100% of what it says it is. Receivables maybe 85%, inventory maybe 50%. You have to remember inventory is carried at the lower of its cost or what they think they can realize the value for. Receivables are net of the expected, doubtful accounts, right?
I was going to say, like,
GAAP.
what are your thoughts, I guess, so if you're looking at a net, maybe it's in a unfavorable industry, maybe the company is a bit unfavorable right now.
Yeah.
So how do you think about inventory then? So if the business itself is unfavorable,
yes,
does that mean that inventory, you have to haircut that by, to be conservative, a pretty decent amount because it's already unfavored in general? So maybe that inventory is not worth as much as it is on the books? Or
it depends on what form the inventory is in.
Got it.
So we talked about a company recently that the inventory, a large amount of is probably Rolexes that were acquired at like wholesale type values. That inventory is fine because the company could always sell it. It could always be moved around. It has a very high value compared to its weight and stuff. It's easy to sell anywhere in the world. So there's a market for it. It would be very easy to liquidate that. On the other hand, things like, say, inventory at Sears or something is pretty much worthless because it's already it's not very good inventory that you have. It's too spread out in terms of where it is. It's not easy to get rid of all of it at once that way. A great example of that is like the worst inventory you could have would be like fashion inventory or like toy inventory. In fact, I remember in the book, The Everything Store, right?
Yeah.
They talk a little bit about how
Jeff
bad
Bezos.
Amazon's experience was.
It's pronounced Bezos, not Bezos, for everybody that pronounces it like that.
So I think
Sorry, it's a pet peeve.
they got maybe 10 or 20 cents on the dollar for the toys that they had to get rid of because they bought a ton of toys that made a terrible mistake in doing it. And it's seasonal and they're worthless like right after Christmas if you have that, and you have to sell 5,000 of these things suddenly, and the offers that you'll get are, a tiny fraction of what you would buy it for. So, there's some cases, probably plant and equipment, there's some cases where you have to pay someone to take it away.
Sure.
Yeah. So, so it's not worth a lot. So it depends on the quality of it. But like in other cases, the quality could be very high. I've seen companies where the inventory is in the form of the inventory could be in the form of Rolexes. That's like a great thing to have.
Holds their value.
Yeah, but I've also seen things that are, diamonds, gold, any of those things that's very easy to predict. But even things that aren't quite as easy, that could be things like steel and stuff. There's real cost with getting rid of them, but you could kind of see what the value is there. There's also issues about like the inventory accounting, whether they're using LIFO or FIFO and things like that. Yeah.
And obviously you could get all that information in the notes.
Yeah, so you read the notes to the inventory, and the inventory will break down the form that the inventory is in. So finished goods would be the best kind of inventory that you have that you're ready to sell, Then you have like work in process inventory, work in progress inventory, and you'll also have just raw materials in there. Mm-hmm. And depending on the company, some of that early stuff could be very not valuable. I actually wrote up something about a company that way where I was concerned about the inventory position. They had a huge build in inventory, and not only that, it wasn't finished inventory. It was a very large build in the very early stage inventory, which for the kind of thing they were doing is like not having a very high value. Mm-hmm. So it's concerning that way. And I just sort of didn't like that. And the company, that company, the auditor wasn't very good. And also they were borrowing against the inventory. So I wondered if there were some things associated with that, like if they were stating the inventory incorrectly to have a better ability to borrow or something. Mm-hmm. But because that's one thing you have to remember, that some companies you have to read how they're borrowing money because some will be borrowing against receivables, inventory, things like that. Yeah.
What are your thoughts of like when you see land and stuff like that on the books?
That's great. That's the best thing that you can find, and that's
Why
the
is
thing
that?
you spend a lot of time to find out about. Well, it's illiquid, but it holds its value very well.
Sure.
The first thing is how it's recorded on the balance sheet. So it's almost always going to be recorded at a value that is lower than its actual value today.
Yeah.
Because in the United States, you're not going to be writing the value of land down under GAAP, but you're not going to be writing it up either. This is different in some other places. So you're not going to be writing it up, and that means that just inflation over time will mean that the land will be more valuable, probably. So I've seen companies, we've talked about some companies, Maui Land and Pineapple, Cool, the timber company, that carry land at 100-year-old valuations or something like that. But I've even seen things just like a company headquarters that was carrying it at, I saw a company that was carrying something at $50,000. It was in New Jersey. And I knew from New Jersey originally, so I knew a little bit about it. And I figured that it was worth, many times that. It could have been worth close to $1 million or something, more likely. And then you look up the property records, county records, usually in the U.S.,
Which is all public information.
Yep, but it's different for every county and everything. There's no central land registry for all that stuff, so you're just going to have to find out, type in what county you think it's in, try to find the parcel number or something like that. So you'll just type in every possible iteration of the name of the company, looking for it. Very old records are they're very commonly put under different names, like because they probably were written down or something. They weren't computerized originally. So if you're looking at things back in the 50s and stuff, like there's a company that's liquidating called Paradise. So some of its land is listed as Paradise Fruit Company.
Sometimes they do like fruit cups and stuff, right?
Right.
Yeah.
They do candied fruit, like for fruitcakes.
Yeah.
For ingredients for fruitcakes. So like
Very small company.
Yeah, and it's liquidating. But to find their land records, you'll notice that some of it is under like Paradise Fruit Company, Paradise Fruit Co., Paradise, and then there's different ones where things are put in parentheses, commas behind it, whatever. In more recent years, usually it's computerized and it's much more standardized, but you're going to find things like that. The same thing when I looked up things about NACO, there's slightly different variations on the name, so you have to be careful about how you do that. But that's true for all sorts of records. It's true for legal records. It's true for all sorts of government records that you have to try all different variations on the name and stuff. Yeah.
Sure.
So a lot of time spent looking at land, look at the satellite images of it, try to figure out what is around it and get an idea of it that way. Definitely look at the tax appraisal, and then also you'll try to Google around to figure out in that county or in that state or whatever whether how similar the appraisals tend to be to the market value. Because in some places there'll be a tendency to have the appraisals be way below the market value or something like that. Yeah.
And then we do that with Howard Hughes, right?
Yep.
Yeah. Howard Hughes Corporation.
Yeah.
That owns a lot of real estate in New York and stuff like that.
Yeah.
And also Texas as well, Houston area. Okay, let's go down to the current liabilities.
Okay.
And obviously there's accounts payable, and this is, of course, like I said, Apple 2019 Q3 earnings. Deferred revenue, obviously that's a good sign of float.
Yeah, deferred revenue is a great sign of float. That's something that you want to see all the time.
So what is deferred revenue for those that don't?
Deferred revenue is just it's payments that you've received but you haven't earned yet. So basically, it's
so you received the cash,
you
but
received
you haven't
the cash.
booked it as revenue yet.
You haven't booked it as revenue, and the reason why you haven't booked it as revenue is because of the way that GAAP matches your costs, your expenses, and your revenue. So, for instance, the classic example is like a subscription thing. If you take a subscription on January 1st, even if the customer isn't allowed to get a refund or whatever, then you will be providing the service for 365 days. Then you'll be just booking that revenue over time.
So
that
charge
entire
it
time
off
that you do
technically
it.
over the
Right,
year.
because your expenses are going to be equal for like each day, basically.
And obviously
kind of
that's
thing.
a sign of float because the company has the cash in hand today or
Correct.
in-house today that they could do stuff with, but they don't have to technically pay it out or whatever.
Right, in a sense, they're underreporting their earnings. They're not underreporting it so much as they're reporting it later.
Yeah.
Yeah.
What? Okay, we can move down with Apple commercial paper. This is a sign of current liability.
Yeah, so commercial paper I don't like to see generally. There's a reason why Apple's doing it and stuff like that, but commercial paper is a way of borrowing that I don't like as much. It's a financial liability that you're using in place of debt. So, we could get into more about debt, but in general, I don't have a problem with companies having a lot of debt. I have a problem that they borrow too short and have to refinance too often, and they hold too little cash on hand.
And commercial paper, because it is on the current liabilities part, obviously it's a shorter term.
It's very short
version of
term.
that,
It's the kind of thing that would go terribly difficult to refinance in a financial crisis. It's the kind of thing that the fact that GE was using it was the kind of thing that would cause them problems in the financial crisis. Very, very high quality companies can use commercial paper, and there's many reasons why they might do it. I don't know why Apple's doing exactly just to lower their cost of borrowing, if it has something to do with where their tax stuff is, that they have money in other countries and they want to have liabilities to be able to use cash here, things like that. I don't know. But with smaller companies, you're not going to see that they issue commercial paper.
So when you were just saying that you don't have problems with companies using debt,
right?
Maybe let's expand on that a little bit.
Sure. So long-term fixed debt, I have no problem with. So lots of long-term fixed debt, but that's not what companies do. They used to, a long time ago, issue a lot of bonds, long-term bonds at fixed rates with maturities that were fairly equal over time, a lot of the time. So, you would have things maturing in 5 years from now and 6 years from now and 7 years from now, or 5 years and 10 years and 15 years. And it'd be fairly easy to refinance each of those things. We talked about a company recently, I don't think it was on the podcast, I think it was off air, Sydney Airport. And I was saying how they did a fairly good job compared to most companies today, but not as good as I'd like to see in terms of making sure that they spread out so that in any 1 year they never had more than like 10 or 15% of their debt coming due. But they had huge amounts of liabilities, like levered, right? 6 or 7 times EBITDA or something. Yeah, like that's just standard for them, what they would be aiming for. That's not a highly levered position. That's just what they always want to be at. Airport's obviously very safe business to put that kind of debt on. But so generally my problems are that companies don't hold enough cash, and that they do things like use commercial paper or use bank loans and things that are fairly short term, and so they have to be refinanced. My big concern is that a large amount of refinancing will have to come due in the same year. Let's say the stock drops a lot. Let's say they don't have a lot of cash flows or something in that year. It's suddenly become very expensive to refinance. If the company thinks, okay, well, we'll issue stock, the stock's going to be very cheap, so it's going to be a huge dilution that year. Yeah, so there's just things that the timing can be really bad by doing that. Yeah.
Now, when you are looking at companies that are carrying debt or maybe just a lot of debt, what are your thoughts on like debt to like EBITDA? I mean, how do you typically think about that? Is there like a limit on what you like to see?
It depends on the business.
So it's like a service company, for example, like an Omnicom, which is an ad agency, is a very capital-light business. It could sustain a lot more debt in theory.
Yes. So if you have first thing is if you have free cash flow every single year, you're going to be a lot safer. If you don't have free cash flow every single year, it's risky to use debt. Yeah. Because you might need a cash infusion into the business in some years. So that's a huge difference. In general, I think I've said before, 3 times debt to EBITDA is fairly safe in the sense that not necessarily that whether I think it's safe or not, but I think you would still find banks that would be willing to lend to you as long as you stay under that. So if you have 1, 2 times and then you need to borrow, I think banks will lend to you. I think it would be better, though, to have 4 times debt to EBITDA and a year's worth of EBITDA in cash on hand at all times. I would rather see that. And then, but the other things have to do with like a major issue that you'll see is, I think Buffett even talked about this. It would be nice if the free cash flow, if the debt isn't too many years of actual free cash flow left over afterwards. See, what you're talking about is sort of like debt to EBITDA is a very private equity way of thinking about it. But their exit plan isn't really to ever pay off the debt. It's to take the company public again or sell it or something. And then someone else will have to delever it, The problem that you have as a shareholder is that a lot of the things that you think are going to be used to buy back stock, pay dividends, fund growth, and whatever is really going to go to pay down the debt if there's too much of it. So, if there's 4 or 5 years, let's say free cash flow is $10 million a year and the company has $40 or $50 million of debt, okay. If it is 80 or 90, I don't care what the debt to EBITDA is. That's just too many years of it. And it's going to be potentially a big problem for you in terms of that so much of it's going to be used to deleverage. You have to remember that as a shareholder, you want to buy into a company that's overcapitalized and going to increase leverage while you own it and avoid companies that are over-leveraged and decreasing it. Yeah, exactly. You want to be in the situation where you own it while it leverages up. You never want to be in a situation where you own a business that's deleveraging.
Got it. Shareholders' equity? Right, that we could go down to that list.
Yeah, so shareholders' equity doesn't really matter except in terms of tangible equity with some businesses where it's a real constraint on their earnings. So, banks' tangible equity matters. We've talked about that a little bit, mostly for regulatory reasons and things like that. But it also can matter for companies that have I was looking at a car dealer recently or something. It's just a very capital intensive business. We talked about Monarch Cement.
Yeah.
So you can often like try to figure out what you think the reasonable returns might be based on their amount of tangible equity that they have. In terms of including goodwill and all that stuff, it doesn't matter to me.
So you take out goodwill.
Yeah, people ask this question all the time.
Yeah.
The basic thing is that doesn't tell you anything about the business.
Yeah, just
Things like goodwill, that's going to tell you just basically what their past acquisitions and stuff were done at. So it might be a way to look at management's past capital allocation, but it's not a useful way to think about the business. No.
Okay, so we just went over the assets, the liabilities, shareholder equity. What calculations do you typically do when you're looking at a balance sheet? So I know you had just in the beginning of the episode, you talked about current assets to total liabilities.
Right.
What else do you do? So do you take like a cash flow measure on like return on assets, for example, or how do you typically do that?
Yeah. So the most important ones are usually done by taking something from the income statement and then comparing it to the balance sheet. So the big ones are turns. So
Inventory turns?
Yeah, so sales divided by net tangible assets is the first one. But then also sales divided by cost of goods sold. You can also just use, cost of goods sold divided by inventory. But the reason for doing that the reason why you would do that is to see how much the actual turn is versus like how much the profit is causing that to look like you have high turns. A good example would be like Tandy. So Tandy leather doesn't have very high turns, but it does have very high gross margins. So as a result, its sales look very high compared to the amount of inventory that it has, but the actual physical amount of inventory turning in terms of how long it stays in the stores and stuff isn't very good. It's just that it's marked up a lot. And so that causes you to think that there's high turns when really there isn't. Whereas you take a supermarket or something, it's the reverse. So you can use both sales, but also cost of goods sold. Also, the same thing, you can look at turns in terms of property, plant, and equipment. And I break it down, each of those things usually. I mean, I did a big report that subscribers to the website can see on Hunter Douglas, and we get more into detail of exactly why it earns what it does. And it gets into like things of how much PP&E they have, which is significant for them, and why we think that means they can't earn too much based on that,
Yeah.
The other thing that's really simple on the balance sheet, though, is whenever you see this, you can just do the percentage of each thing, of each of the items on it as a percent of the total assets, right? So you're just going to go down and you're going to say like, okay, so how much is receivables? It's really easy to eyeball these things.
I do that because you kind of get a good feel for the business,
right.
I think, yeah.
So if receivables are 5% of total assets or if
Yeah.
receivables are 80% or something, and then you know what to pay attention to. Like I'm talking all this stuff about inventory, but if inventory is this tiny number that doesn't matter, then let's not talk about it.
And over time, you do learn to kind of eyeball it, but it's I think it's still good to kind of illustrate it.
Right,
as
absolutely.
like a roadmap,
Yeah, so I would use those percentages. And the same thing on the liability side, where that gives you some idea of like, okay, well, what if they could change something about their working capital cycle or something like, do they depend a lot on the deferred revenue? And if they change their business model so they didn't have that deferred revenue, would that be a big problem, And usually things like that aren't going to change, but sometimes the company will tell you, oh, we're planning to change the way we do our distribution centers and our stores and things. We're going to carry more inventory or whatever. So it helps to know what the balance sheet looks like and then to know how much that matters.
Sure. Yeah.
Right.
Now, like return on equity, obviously you speak a lot about that on the podcast, and it's a big part of your investing process and the way you think about things. So how, for example, Apple, how would you think about their return on equity? Or like what would you do, I guess, when you're looking at a new company?
Generally,
how do you think about return on equity?
So there's a few ways of looking at it. One is like a pre-tax number on their net tangible assets. Yeah, EBIT. I actually just use gross profits, EBITDA, EBIT, and free cash flow. I check all of them to see what the differences are. There are not going to be a lot of big differences in many cases, but sometimes you'll see very big differences and it matters a lot. So like with a very small company that's having problems with scale, it might have very high gross returns on its assets. And that's a very good sign if it's going to be quickly growing, that it's going to have really impressive economies of scale and is going to eventually become a very high returning business. You probably could see that in Apple's history, where when it was first just emerging from having problems, it already was having high gross returns, but it wasn't yet delivering really high returns on equity until it got a huge amount of scale, and then the returns on equity would get really big. You want to avoid companies where the gross returns are really poor because it's very hard to grow your way out of that.
Sure.
Yeah. And then, the return on the net tangible assets is what I focus on, which, like I think I've said before, a really easy way to just guess at what that is you take receivables plus inventory plus property, plant, and equipment, and you subtract accrued expenses and accounts payable. And that number usually for most companies is the actual tangible equity that you know is in the business. Now, so there's some other stuff that might be in the business, and there's some other stuff that might be a liability. That means you don't have to put the money in yourself as a shareholder. There might be deferred revenue or something. But what I just gave you is for many companies going to be a really quick approximation that you can do like in a split second, basically. Yeah.
Cool. Well, that is the end of the podcast going over the balance sheet. We'll probably do another video going over the income statement too. I think it's good. I mean, a lot of people, I think, are always interested to learn about like 10Ks and financial statements, and even if they understand accounting and like what the line items mean, I think they like to just hear about how you sort of interpret it into the vesting, process. So I think it's good to do that. So I want to thank everybody so much for following along. If you want to get access to Geoff's free weekly Gazette that goes out, you could get on our email list. Go to focuscompoundinggazette.com and be sure to sign up there. If you're watching this on YouTube, thank you so much. Hit that subscribe button and thumbs this video up. Everybody else, I want to thank you so much for tuning in, and we will see you in the next podcast. Take care.
Hey, this is Geoff Gannon, and that was the Focus Compounding Podcast, the podcast where Andrew and I talk general investing concepts. To learn about specific stocks I like, go to focuscompoundinggazette.com. That's focuscompoundinggazette.com, and enter your email. Once you enter your email, you'll start getting one free 2,000-word stock write-up a week. Andrew and I also manage accounts for clients. To learn more about our managed accounts, email Andrew at info@focuscompounding.com or text or call Andrew at 469-207-5844. Thanks for listening.